Hey, what's going on, guys? Today we're talking about leverage strategies when it comes to yield farming and when it comes to investing into crypto. What is the risk behind it and what is the danger behind it? Because this is a pretty popular strategy, right? People just lend out different crypto assets, like, for example, Wrap Bitcoin, Coinbase Bitcoin, Ethereum, or even smaller chains like Solana, BNB, Sui, AVAX. But the main problem here is that if you don't know the risk and you're over leveraging or exposing your whole portfolio to leverage, you could be easily liquidated on an aggressive downtrend, right? And we saw that on the October 10th liquidation event. I'm sure a lot of people that were using leverage on like smaller chains like maybe Sui or AVAX got liquidated or were forced to deleverage because of the liquidation cascade and the shift in price action that we just saw in the last few weeks, right? So this could be a really great strategy in an uptrend, right? If you are, for example, lending out Ethereum, you're borrowing USDC, and then you're yield farming maybe ETH to USDC if you want to be long. And then you could actually earn some extra fees to like repay whatever you borrowed, right? This works completely fine on an uptrend. But if the trend reverses, and your entry was too high, then you could actually be sitting in a loss and be in the danger of liquidation, right? Because sometimes prices could move down quite aggressively towards the downside, and we never know when a black swan event is going to come. So in this video, I will cover the main risks I see with this strategy, how I personally manage it so that hopefully it could help you out. And if you're new here, my name is Richard. I'm a DeFi investor and a yield farmer. This is a particular strategy that I help people set up and my clients as well. But you got to know how to do it right so that you don't actually blow up your portfolio while doing so, right? I've seen too many people like blow up their portfolio because they're over leveraged or they're following strategies that maybe they saw on like X or on YouTube that is simply not very sustainable or is just too high risk, right? The main problem, again, with this approach is prices could draw down pretty aggressively. If we look at even Bitcoin's price action, which is like less volatile than most crypto assets, right? We saw that in the last cycle, there was a period of time where the price draw down pretty heavily and kind of was sitting in this 100-week simple moving average. And then it kind of bounced around for a few weeks, right? Maybe a month or two. And then finally, there's a huge downtrend here. So if you actually were back here and you didn't see the downtrend coming, could it have been possible that you predicted the downtrend? It's probably not very likely, right? Because you could have easily argued that, okay, maybe Bitcoin is sitting on this zone of support here with this moving average. Maybe it's just going to kind of just chill here for a while for another leg up. But in reality, it did not happen, right? Clearly, the price actually went up a little bit and then went down pretty aggressively. And if you did not have cash to actually deleverage, then you could actually be forced to be liquidated or you're going to be selling your positions at a loss to deleverage, right? If you took out, like, for example, some leverage at 40K, price went down to around 20K, and maybe your LTV was around like 30 to 40%. Maybe your liquidation point would be around here or slightly lower, right? So if you actually want more safety and the price is dropping pretty rapidly, that could be pretty bad. And the reality is we never know how much Bitcoin is going to drop by or assets like Ethereum is going to drop by, right? We could take a guess, like maybe it would bottom out at 2K or 1500, but we never actually really know. So we need to be really careful when using leverage. And this is especially bad if you guys are pairing leverage with tight range liquidity. So let's say you were yield farming ETH to USDC and you were lending out, let's say 10 ETH. So 10 ETH is worth about like $40,000 to $50,000 at the peak, right? And then maybe you took out 20K to actually yield farm with. If you actually use a tight range liquidity pool, maybe a range that is between like 4 to 5K, the capital that you actually borrowed would be down pretty aggressively right now, right? Most likely at least like a 30% loss. It's sitting in a 30% loss. And then if you're actually forced to deleverage, if the price actually keeps trending down, then you're going to be locking in a ton of losses, right? And of course, there are different ways to manage it. For example, you could withdraw the liquidity and add it to the collateral to kind of give you some breathing room. But most people that are combining a tight range strategy with too high of an LTV is going to be at a very tough situation, especially when you are exposing your entire portfolio to leverage, right? I always say to my clients that, hey, if you want to use leverage, you should be using only a portion of your portfolio for leverage, simply because sometimes if the price did not move the way you expect it to, you need to be able to have other assets to add as collateral so that you don't need to be forced to lock in your losses and to liquidate your position, right? You don't want to be forced in a position where you have to be liquidated and have to pay the liquidation penalty when that happens. And one thing to realize about leverage is that it cuts both ways, right? If you guys don't already know, leverage could accelerate your gain, right? Let's say you entered into an ETH to USDC position at $2,000 with leverage. Then when ETH price goes up to like $4,000 to $5,000, assuming you're still in range and you set a wider range, like I recommend people to do, then you actually would be gaining much more assets than not actually using leverage, right? But at the same time, if prices go down from your entry, then your losses could be actually accelerated and your loss could be even greater than whatever fees that you earn in some cases, right? For example, maybe you were using that leverage strategy when ETH was at around $3,000, like earlier in the year, but then ETH suddenly just goes down to like $1,500, right? A lot of people got liquidated from that dump if they did not actually have enough collateral or they were actually overexposed to that strategy. So it's very risky if you don't know what you're doing. And it's especially risky if you are using a tight range leverage. And I never recommend leverage for people who are beginners or already very heavy into altcoins. If you're already into altcoins, you're already taking in a lot of risk. There's no actual need to introduce more leverage to altcoins, right? Because a lot of these altcoins could go up by like, 2x, 3x, 10x, or even 50x if you're buying like smaller caps. There's no need to actually put leverage to that because you're just adding additional risk to whatever portfolio that you have, right? It just doesn't make sense to be like putting on so much risk when you're already taking so much risk with altcoins in general. And even with stuff like Ethereum, even though I am a long-term believer in Ethereum, I don't think it's a great idea to be like over leveraged on Ethereum, right? Another strategy that people like to do is, let's say you lend out like ETH and Bitcoin, you borrow stable coins, and then you use that stable coin to maybe deposit into different places that has like a higher APR for supplying than the borrowing costs you're paying in Avid, right? Let's say the supply, you're getting like 12 to 15%, and then maybe Aave charges you like 6%, and then you can pocket the difference. It is less risk if you are using safer protocols, but at the same time, you are taking additional smart contract risks when you're doing that. And typically, those protocols with higher yields are going to be higher risk than protocols with low yields, right? That's the way it works. You can't really get like really, really high APR without actually taking on additional risk. And I've seen it time and time again that, people post on like either YouTube, on X. There's a bunch of accounts out there that just basically show you that you could earn a ton of fees with like yield farming type ranges, right? But if you actually dig deeper into like the profit and loss of those strategies, a lot of times what you're going to find is that they're actually net unprofitable over time, simply because these strategies are not very sustainable, right? Let's say you're setting a $1,000 wide range on Ethereum. You can see most of the time, Ethereum just doesn't stay in a $1,000 wide range, right? Especially when the prices are high, because when prices are high, a $1,000 wide range is actually tighter in percentage terms when compared to when the prices are cheap, maybe in the bear market, right? But even then, I personally would not be using a tight range for liquidity simply because you cannot really predict like future volatility with accuracy, right? Because a catalyst could drop at any time and send like the price upwards or downwards. So we don't want to be using tight ranges in most cases, and especially not so if you are using leverage and on like pairs like ETH to USDC, right? You don't want to be using leverage. And then some people would teach you to like, for example, you could borrow out more USDC to then put it to the bottom range or do like some other complex strategy. But in reality, that's just driving up the risk of your portfolio, right? You're continuing to add to your long exposure. On the way down, you're dialing up the leverage. And if the prices don't reverse to the upside, or if it takes too long to reverse, then you could be liquidated as the price actually goes down pretty aggressively, right? So you don't really want to be too overly exposed to the strategy. And when I show people the strategy, a lot of times you're going to find that the actual APR you're going to be gaining is not actually quite that high, right? If you're using like ETH to USDC as a pool, for example, and lending out maybe 10 ETH, like what I said, right? And usually I like to personally use this strategy when I'm pretty sure that the prices are going to be bullish over the next 6 to 12 months. I don't want to be taking on additional risk when the market is really shaky and a big drawdown is like kind of in progress, right? But let's just say ETH is trading at like $2,000, right? So this 10 ETH is equal to 20K USD. And then let's just say you borrow 10K, right? What you're going to find is that the interest rate you're earning on your ETH is going to be a bit lower than the borrowing costs usually if you're depositing on Aave. So that kind of cancels out, right? Maybe a 3% yield on 20K and then a 6% borrowing cost. So the 3% yield kind of like cancels out the borrowing cost, right? So we're getting like 0% yield if we're just doing this. But then let's just say you put like 10K into ETH to USDC, right? Maybe that ETH to USDC is pulling 30% APR because maybe you went with a slightly tighter range, but not too tight to stay safe, right? What you're going to actually find is that your net APR is going to be around like 15%, right? Because the borrowing cost cancels out and then the return on your capital is actually 15%. So you might be looking at 15% and feel that that is quite low. In my opinion, that is still really great on like a lower risk pair like ETH to USDC, right? So 15% is not bad, especially if you are using wider ranges. And of course, you might think that like, hey, 15%, I might as well just not do this or use wide range liquidity pools, right? And that's exactly what I prefer as well. I just prefer a simple wide range liquidity pool because then I could be putting much more capital into those pools. I don't have to worry about leverage. And then if I go down out of range to the downside, I could choose to actually take out leverage at that time if I want to, right? So you don't necessarily have to use leverage. Of course, the benefit with using leverage is if prices keep trending up, I'm going to be getting the full appreciation on this 10 ETH, right? But again, you want to be really careful of doing this when the prices are kind of high already, because if the downtrend does come, and it almost always does, you're going to be at a point again that you have to make really tough decisions, especially if you're knocked out of range with the tight range, because then you're not actually earning any APR on this ETH to USDC anymore, right? And then you're basically at 0% APR. And then you actually have to worry about this borrowing cost compounding while the ETH price drop could actually liquidate you. And one of the strategies that I teach my client all the time is that we actually have to withdraw the liquidity if the prices are trending down too aggressively. We could add that to the collateral side and then maybe repay some of it, right? We repay a little bit of the USDC, add some ETH to the collateral side, and then that is going to actually drag down your liquidation point. So maybe the liquidation point was around like 1500. And then after doing that, it could be dropped all the way to maybe 800 or lower, right? So that is a much safer strategy. But at the same time, you are still taking risks in that case because we never know like how low the market is going to drop, right? Ethereum and Bitcoin kind of trade like a tech stock. It's just very volatile. And that if prices swing towards the downside too much, if you're using too much leverage and then exposing your entire portfolio doing so, and then you actually don't have a way to easily repay the loan, then you want to kind of think twice on whether or not you should be using leverage, right? And because sometimes you don't know what other people have on the side, right? Maybe they're using leverage, but then they have a lot of cash on the side that is sitting in the bank that they could basically on ramp at any time to repay the loan. Then you don't really want to be copying other people's strategy, right? Or if they have a business that is making like tens of thousands of dollars per month, they could easily repay the loan while you can't, right? So, and in my opinion, it's not really suitable if you don't have a very easy way to actually repay the loan, or that borrow amount is actually quite a lot of money for you, right? If you are, for example, not comfortable borrowing 10K and owing that 10K, then you actually don't want to be exposed to leverage. And again, you don't really have to use leverage to be profitable in the market. In my opinion, you shouldn't be trying to like maximize 100% of the profit because you cannot actually capture 100% of the profit in the market, right? We're going to make like buying and selling decisions. Sometimes we make wrong decisions and that would incur some losses. And then sometimes you make really good decisions and would give you a higher than average return, right? But if you're not actually comfortable with taking that risk and understanding the numbers before you deploy, you don't want to touch leverage in general. And again, the lower the price of ETH, the better it is to use this strategy because we don't want to be in the situation again when the prices drop pretty hard, right? And it's sometimes really tricky to like say when the price is going to bottom out. You could have easily argued back here that, okay, there's like key moving averages here. I don't think ETH is going to go lower than that. And then, lo and behold, you can see ETH actually dumps further, right? So this is why, again, I don't recommend exposing your whole portfolio to leverage. You should be using like different strategies like crypto to crypto pools or other crypto to stable pools that is not exposed to leverage. And the way I personally like to do it is I don't like to keep this position perpetually open, right? What I like to do is if I decide to borrow out, I borrow out. And then I actually repay the loan pretty aggressively to actually deleverage myself while the market is still actually doing pretty decent, right? I don't want to be forced to deleverage. I want to choose to deleverage and reduce my risk over time rather than be forced to, right? Because if the prices do go pretty cheap and you can like take out another loan at any time, right? You don't want to be like keeping your leverage position open forever, especially because this industry is quite volatile. And the way I like to look at it is kind of like this, right? Like risk and time. And if you're using leverage, it's actually, you're taking much more risk than normal. And then you want to kind of like reduce your risk over time, right? You don't want to kind of just keep your risk up here and then eventually your portfolio blow up. Or you don't really want to like keep dialing up the risk over time, right? You don't want to keep like borrowing and borrowing and borrowing. And then over time, if something bad happens to the market, you're going to be actually blown up. And personally, what I like to do again is to repay and deleverage over time like this. And if I'm actually running an LP that is not exposed to leverage, my risk might start down here, right? But maybe because with leverage, it is easier to earn like a return in some cases, again, when the prices actually trend up over time. So I could actually get my return on capital faster. But in the beginning, it is more risk, right? This is like basically the no man's zone and that where you basically have to take the risk and kind of pray that the prices don't retrace, right? So this is the reality of leverage. And this is how I personally think about leverage. Hopefully it's helpful. And this is what I do with my own personal portfolio. Again, I don't really like taking leverage if I don't really have to. And if I do take out, I want to make sure that it's very comfortable for me to repay the loan, right? If I take out a 10K loan to buy different assets or to the LP, I want to make sure that my portfolio is, for example, generating a few $1,000s a month to like easily repay the loan or at least a few $100s a month. And then I have some cash on the side in other investments or in like other crypto assets that I could add and deleverage if I really, really need to, right? So hopefully that makes sense, guys. Again, leverage cuts both ways. If you're taking leverage and then prices retrace, your losses are actually accelerated. But if you're taking leverage and the prices are going up, your gains are actually increasing faster than the market, right? So hopefully that was helpful. And if you want to learn more about yield farming, feel free to check out the other videos on my channel. I have a pretty strong investment background. That's why I know these concepts really well. So hopefully it helps you out. And again, I don't recommend using leverage if you don't know like the numbers behind it and you don't really have a system to handle that drawdown. And the drawdown is going to be much more aggressive than if you're just using no leverage, right? So that's something to keep in mind as well. If you can't stomach a very volatile portfolio, we definitely don't want to be overexposed to leverage. So that's pretty much it. Thanks for watching. Take care. Don't get blown up. Don't use too much leverage and stay safe out there. See you on the next one.